If you had $250,000 to invest today, how would you turn that into passive income, tax savings, and maybe even buy back your Fridays? Most dentists spread money around randomly. A little crypto here, a buddy's startup there, and a whole lot of index funds. And a whole lot of money sitting in your checking account. But today I'm going to show you exactly how I'd build a diversified passive portfolio with $250,000. This is the same blueprint my team at the Walk of Wealth Mastermind community uses with our members. What's up, everyone? I'm Dr. Johnny Walker, aka Jonathan Withanacci. I left full-time endodontics a few years ago to become a real estate fund manager and the founder of Walk of Wealth community. I help dentists build passive income, reduce taxes, and create the kind of time freedom dentistry alone will never give you. Now let's jump right in. Here's the truth. A lot of dentists have $200,000 or $300,000 sitting around doing absolutely nothing. It's the comfort pile. You look at it every few months, you get a warm feeling and you say, nice. I should probably do something with it, maybe invest it, but then you actually never do it. And when dentists do invest, well, they usually buy 5 different tech stocks and call it diversification, or the Magnificent Seven, as the stock market is completely valued by a handful of stocks. That's not diversification, ladies and gentlemen. No matter what your financial advisor tells you. That's just called gambling in different flavors. $250,000 is the perfect amount to start building a portfolio that produces cash flow, that lowers taxes, that spreads risk, and starts giving you real freedom. Now, before we allocate a single dollar, you need the right mindset. And there are 4 rules. Rule number 1, cash flow is king. Buys your Fridays back, right? Hey, I don't got to go to my job anymore. I don't have to go to the office anymore because I have enough cash flow that it replaces a day that I don't work on Fridays anymore. Cash flow is king because cash flow buys Fridays. Cash flow buys options. And if you have enough cash flow, it actually affords you financial freedom. And we are headed for times of inflation and economic uncertainty. Asset prices in general could get a rude awakening and repricing. That's why having assets that cash flow will be ever more important in these times. Rule number 2, diversify by asset class, not by stock ticker. You have to invest in assets that buy cash flow or income. Things like multifamily real estate, self-storage, oil and gas, medical real estate, senior care, and private equity in essential businesses. Not Microsoft, Apple, Nvidia, Oracle, Amazon, Alphabet. Rule number 3, reduce taxes while still growing well. By learning ways to mitigate taxes and pay the IRS less, it allows us to keep more of our hard-earned money while at the same time helping grow people's wealth. Rule number 4, the operator is more important than the pro forma. A pro forma is pretty much garbage. It's a way to look at it. It might give you a good idea. It might be painted in a very sellable way, but a pro forma is nothing more than an educated guess into the future. More important is who that sponsor is, who will be operating the asset that you're investing in. That a great operator makes up for an average deal, whereas a bad operator can destroy even a great deal. This is why you invest with people. You invest in people, not spreadsheets. All right, so now let's get into what you came for. First thing I would do is map out my strategy based on risk tolerance, timeline for investing, goals from investing, etc. Now, for our mastermind members, we actually have each member fill out a 5-page intake form so that we can get clarity and get a clear idea of where they are now and where and when they are trying to go next. After we've clearly identified what the goals are and we're in alignment, we can then sit down with each member and help them build out a customized personal strategy based on their individual goals and needs. Now, based on my results from the test, this is exactly how I'd allocate $250,000 of passive capital. Now, I filled out this form as if I was an investor, which I am. If I had $250K to invest in 2026, this is what I would do with it. I would put 40% of it, or $100,000, into multifamily value add commercial real estate. This is your foundation. It's a stable, recession resilient, some people might even say boring, but in investing, boring is beautiful. And why exactly multifamily? I know some people that invested in multifamily in 2021, 2022 may have got burned with capital calls or even loss of capital. But this is a blip. And that was when multifamily was at the top of the cycle and it was overheated and people were overpaying for things. But at the timing of this recording, multifamily is in a trough. It's at the very bottom of the cycle. And when it's at the bottom of the cycle, there's less enthusiasm from developers, so they're not developing any more new product. And in certain markets where people continue to move and median income continues to grow, they will still be competing for affordable housing. And if there's no new supply of affordable housing, that means there will be increased demand for in-place supply. And this only results in higher rents and higher valuations for commercial real estate. This also means, from an investor standpoint, strong cash flow. You also get depreciation, which helps to offset any passive income. You're also at the same time building your wealth, right? So these multifamily properties, these commercial real estate, they tend to appreciate over time. So you're making money from the cash flow as well as getting a piece of the appreciation as the value of the property goes up. Multifamily is the bread and butter of any dentist's alternative passive investment portfolio. That $100,000 that I want to allocate into multifamily real estate, I would look to not just throw that into one multifamily deal in one operator in one geographic location, but instead I would try to invest that $100,000 across 2 to 3 different deals in different markets and different operators. This helps me to mitigate my risk within my multifamily real estate allocation. Number 2, I would take $50,000 and drop it into an asset class like self-storage or boat marina park. Self-storage is simply predictable. It's in demand as people downsize in a weakening economy, or they move, or they get divorced. They inherit things they don't actually want. And your storage unit quietly cash flows month after month. Now, why do I love it? It works even in secondary and tertiary markets. Very low maintenance. You tend to have sticky tenants. Tenants don't move in and out. Like, it's very inconvenient to move stuff in and out of self-storage unit. And if it's low enough cost, it's on their credit card. They don't even notice it, and it stays there for years. In fact, I have a bunch of dental equipment that's been sitting in a self-storage for over 2.5 years now. The other thing about self-storage, they have amazing margins, and it's a perfect balance to multifamily. So now, out of that $250,000 that I have allocated, now I have $150,000 that I know what I'm gonna do with. Now, what am I doing with the rest of the money? Well, number 3, I'm gonna throw $50,000 into a working interest in an oil and gas investment. So that's 20% of my capital that I want to allocate. Now we're talking here, right? Oil and gas is the single most tax efficient asset class available to dentists, period, because it allows us to offset W-2 income. That's due to what's called intangible drilling costs, and those intangible drilling costs allow us to have depreciation. And like I said, these deductions from oil and gas is different from real estate because it can offset W-2 income, 1099 income, and capital gains. No other asset class does this. So if you're paying 45 to 50% in taxes and not using oil and gas, you're volunteering to overpay the IRS. You got to remember, oil is non-correlated to the stock market or real estate, which allows for excellent diversification within your investment portfolio. And the last thing I would do, number 4, is 25 to 50K in private equity, right? So 10 to 20%. This is where upside lives. In this bucket is where you may decide to swing for the fences. Think about companies rolling up paving businesses, like our deal we did in late in 2024 called The Pave. Dental tech platforms, service businesses. So why private equity? Well, number 1, it gives you a chance for a much higher return, albeit it comes with a higher risk profile, categorically higher risk profile, but It is also uncorrelated with real estate. It has strong growth potential. It can have very attractive distributions. It also gives us, as dentists, access to industries you don't have time to build for yourself. It gives you access to industries and businesses that have nothing to do with dentistry or not correlated. Right? So this helps to reduce the risk. And this is how you invest in businesses without being the one managing them. All right, guys, quick lightning round of mistakes to avoid. Mistake number one, putting all $250K into one deal. Even if it feels safe, even if it looks like a home run deal, it's just not smart. All your eggs are in one basket. If that one basket drops, then all the eggs break. Mistake number two, buying a rental house or a short-term rental. Listen, I love you, but single-family rentals are not passive, nor are they scalable. They are another job without dental paychecks. Mistake number three, letting it sit in a checking account. Inflation is the silent killer of dentists who hoard cash. Mistake number four, chasing shiny 20, 30, 40% plus IRRs. If the operator has to hype the deal, conventional wisdom says run. Let me give you a real example. A dentist joined our mastermind group February, so about 10 months ago, and came to me recently with $260,000 just sitting idle. We built him a portfolio almost identical to what I just walked you through. And today, he has 4 streams of passive income, tax savings he didn't even know existed. And he's planning to cut back 1 clinical day per week within the next year. These are moments that make this work special. You're not just investing money, you're buying back your time, your family, and ultimately your life. Now, this portfolio gives you cash flow starting year one, a balanced mix of real estate, energy, and private equity, massive tax advantages, risk spread across 4 different asset classes, a clear roadmap to financial freedom. This, doctors and doctettes, is how dentists stop trading hand skills for dollars and start building a life where dentistry is a choice, not a requirement. If you want to learn more about building your passive portfolio, join my Facebook group. The link's below. And if you're really serious and you want to work directly with me and my team, as well as have first access to the kinds of deals we talk about here, along with education, community, and private coaching, if you are interested, I invite you to apply to the Walk of Wealth Mastermind group. In the description below is a short video describing exactly how the mastermind works. All right, guys, thanks again for your attention. If you got value from this, please smash the like button and please share with a colleague that you think would get value from this. And I'll see you on the next video.